Good afternoon, ladies and gentlemen. Thanks for coming into our seminar. This seminar today is an introduction to HJ Collection. We're going to be talking about permitted development rights and investing for yield. Now, this seminar is at the Landlord Show, the Investor Landlord Show. I hope that you've seen some good stuff today and you've taken away some great information. We find ourselves in a funny situation where we have to do virtual seminars at the moment, but things are starting to pick up and move forward. So hopefully we should see you back live at an event in the not too near future. I'm Reese Meny. I'm the CEO of HJ Collection. With me today, I've got Paul Rothwell. Paul is the owner and the CEO of Empire Property Group. Me and Paul have worked together probably for around 4 to 5 years now on various and past projects. So we're going to give you an introduction to what we do and how Paul helps us fulfill investment opportunities that we find. So Paul, thanks for coming on.
Thank you for having me.
Yeah, so Paul's, I would say, an expert in permitted development rights. He's done PD for a very long time now. And originally, me and Paul met when his group, Empire, wanted to raise capital for investment. So investors to invest in, for them to use a structure called a loan note, which we do here at HJ Collection as well. But that's how me and Paul originally met. Now, Paul, that was successful, Paul. That was back in 2018.
Yeah, before, I think, wasn't it, when we first started?
17.
Earlier than that.
Earlier than that?
I think we started late 2016, 17.
Okay.
And then since that point, we raised probably approaching 40 million with you.
Yeah.
That allowed us to acquire a number of buildings, probably 12 buildings, and create close to 800 apartments, something along those lines. Yeah, so it's really useful for us as a company to have access to that capital. At that time, allowed us to get hold of a lot of buildings, a lot of developments, and make some good headway.
And what that was through, if I move on to my next slide, through to, we used what we class as a property bond stroke loan note. Now, for those of you that know what a loan note is, or you don't, I just want to explain what that is. A loan note is it's a debt instrument with security. The security being a fixed charge over a physical asset. Now, Paul, when we worked with you guys, as you turned around and said, 12 projects, did you say 12 properties?
In the region of that, without me checking the spreadsheet, it was in that order.
Yeah, which was really good. So it's the same as what we do over here as HJ Collection. So Empire originally paid back and come out of the loan note market at the back end of the loan note. Once it was filled, they created, tenanted, refinanced, and paid back investors. Now, HJ Collection is a follow-on from Empire. We basically have used the same business model to move forward with HJ Collection, and this is exactly the same structure as what we use with them.
Correct. Yeah.
So I'm just going to put the slides on so that people can see what a property bond and a loan note is. So, as I said, it's barely a debt instrument where you, the investor, lend your money to a company and you take security over the asset. So probably similar, the easiest way to explain it is when you get a mortgage or when you buy a buy-to-let, you go to a lender, whether it be a bank or a different lender, and they give you the money to purchase the property and they take security over the asset. They lend you that money for the reason being, they've got the security over the asset. Exactly the same as what we do here. So investors lend our corporation, HJ Collection, money. We use them funds to go and purchase and acquire assets, convert them, and that's where Paul and his team play a big part in what we do, which we'll come on to later. And we give you the security. The benefits there is that there's no stamp duty, no fees or anything like that to the investors. So you lend your money and you know that you're getting a fixed return paid back to yourself. So an introduction to our model, what we're running with at the moment and what's working. Basically, it's a professional managed property portfolio where we've got different opportunities in there for 5 assets at present. You've got a fixed exit strategy. So when you'll be exiting. It's a 2-year term. And you know exactly what's going on. HJ Collection would keep you updated to see how our progress is going, what we're doing with sites. We do site visits. You're more than welcome to come up and see us. And we're happy to show people around our sites. So moving forward, the reason, as I said, me and Paul have worked together, as Paul said, back in 2016, moving forward. What we've done is when Empire stopped using the loan note and a property bond, they paid investors back. We looked at moving forward ourselves with HJ Collection, and we've used Paul and his team as our main contractor. So what that means is that we will find properties and I will run them opportunities past Paul. Paul will, look at them with me, see whether they meet and, his expectations and what his team can go in and build out for us. So Paul, will you just talk us through how that works? What you do with us in that instance. When I bring you a site, we sit down, we go through the numbers. Obviously, I lean on you in terms of your expertise when you say, you can get more flats in, or Reece, you're trying to get too many flats in and it's easier to do it this way and that way. We sit and bash it about. But if you can just explain to the listeners, a little bit about what you do and how you help us there, could be beneficial.
Sure, yeah. So whenever you bring a site, as you know, we run it through our appraisal process, which is just like plugging it into what we do generally for our own portfolio and for other clients. So we assess the purchase price and then the associated purchase costs. We go and look at the building with our QS and structural guys and assess what it will cost to convert. Now we've been doing it that long now. We've generally got a good idea of where it would be anyway, but we check it out. Obviously weigh up all the costs, all the associated costs in terms of windows, roof, sectioning out the property, professional fees, all the obligatory certifications, and then weigh up the business plan, and then we obviously feed back to you what we think you should be paying, or whether the price that you've already agreed or preliminarily agreed is makes it work or not. Obviously not every deal works, and
no,
we, as you know, some get turned down, and some you go back into bat and try and get a better deal, and that's what we do effectively. So then when you're successful in acquiring a site, we're ready to go. We just plug it into our existing operation model, and then away we go. Really, we give you a program, we give you monthly updates, and then obviously the loan note funds the development as we go, and we provide you with that service, which is in line with what we do for ourselves, basically.
Yeah, so we basically use your services that you use in-house as well. which is tried and tested, as you've said. I mean, I know we touched on the loan note empire, what we done originally, but more importantly, Paul, in PD, you might need a couple of minutes to think about it. How many units have you converted yourself now, not your team?
So we've got of the order of about 1,500 letting units completed, and we've sold a few off here and there. And then in terms of what's under production at the minute, it's about that amount again. So as we have grown over the years, our productive capability has grown, and we now taking on bigger buildings. So as in the past, it may have only been 5 to 10 units in a development. We're up to anywhere from 20 to 100, even more sometimes. So that means that the amount of properties we've got in the pipeline is growing exponentially. But although it's growing exponentially, we still kind of feel that we're doing it organically. We're not jumping up kind of beyond our means or beyond our kind of capabilities. And we feel quite comfortable at that level. 1,000 to 1,500 units a year is a good production rate, and we're happy with that.
And I suppose some investors might be sitting thinking, well, if you're at that already, and if you're then, we're plugging into what you're doing as well, what is the capacity? So, if there's investors thinking, oh, we'd like to invest, but if they're are they at their capacity? We've got room to scale up, but what's the process for that?
In that capacity, I've built in what we do for you and other clients as well.
Yeah.
So the general idea is that we try to put extra business on top of our own developments through Empire Property Concepts to make the business more profitable, effectively. So if we're unable to take on the capacity, then we would say, but I think we have that much of a run up, and it's not exactly like you drop a project on us. We're very much involved in the lead up to it, so we can program it in. We've got plenty of time to program it in, and so I don't see it really as an issue. It would only be an issue if things were just dropped on us at the last minute, which is not the case.
Yeah. And just a question for you, Paul. Obviously, we're talking today about investing for yield as well. You're obviously a big landlord. You've had many units, and you've still got many units for rented. We're talking today at the National Landlord Show. Majority of investors here that are watching and listening to what we're talking about are landlords themselves.
Yeah.
I'm a landlord, you're a landlord, as a landlord with a few units, there's tax implements, there's problems, boilers, tenants, voids, stuff that all eats into your profit margins. And I suppose buy to let is not, in my opinion, as strong opportunity as it used to be.
Well, I mean, it isn't. It's just, the ownership angle comes with the issues that you just mentioned.
Yeah.
So, and the headaches. Now, obviously, we're doing it on a grand volume, so we don't personally have to deal with the day to day, and people are employed to deal with specific these issues as they come up. As an individual landlord, that would fall on you to sort out, which some people might want to do that, but I dare say a lot of people don't want the headache. So
that's right.
That's I suppose it's the headache factor that you're referring to there, which
and not just that, just taking a step back. I mean, I've just put some sites up that raised for and you completed on. previously, we did run, you know, a report in terms of a white paper, which, you know, if there's anybody that wants to see sight of that, if you drop an email afterwards, we'd be happy to send you over. If you bought flats or houses in these areas, in Bradshaw Gate, King Charles, in Pontefract, in Bolton, sorry, and Wakefield, if you bought a house or an apartment in each of them areas in the time frames that investors lent Empire the money, I think it was coming out, you'd have probably seen a yield of around 5 to 6%, where if you was in the loan note, you got, if you was an income investor, 10%, and if you was a growth investor, slightly more than that. So it depends what you're looking for. As you said, having the ownership of the assets, if you want to own them in your own name. But in this particular instance, you could have, you know, ultimate security in terms of security over these assets, plus a healthier return with less headache. If you was to have invested in these sites, and them documents are available for you people to have a look at in due course and in your own time. So, you know, it's something food for thought for you to have a look at. So what we want to talk about now and just moving forward is the developments that are actually in HJ Collections portfolio. Now, one of them is Attey's House, Cleveland Street in Doncaster. You can see here, you know, the site, what we've done outside with the windows changed. Paul was the contractor on this, completed in time, in the time scale that we agreed. We got some pictures of when it was first started to be stripped out in February 2020. So you can see it was an office space. Paul would have gone in there, well, Paul wouldn't have, but his team would have gone in there and stripped it back to start off with. And as you can see, as we move forward, the windows being changed. And then in March 2021, you can see the completed units in there. Paul, will you just talk us through, you know, not the program in detail, but what goes through, you know, we're also talking about permitted development rights as well. And, you know, it'd be good for some investors might not understand what permitted development rights are. I believe in our loan note stroke bond is different to other opportunities out there because we eliminate planning permission. So at the moment, I know that there's some new legislation coming in, which we'll talk about in a moment. But at the time right now, is we can buy a site and we can start working on it straight away.
Effectively, yeah. Because when we identify a property, we go in for the permitted development rights, which in the local authority are bound to give you a decision within 56 days. So usually the purchase process takes probably 3 months. So by the time we bought the property, we've usually got the permitted development approval through, which is, you know, a lot less onerous than a full planning application. So it doesn't take as long. So yeah, effectively most of the time, and sometimes the PD is already in place because the previous owner's already got it.
Yeah.
And you know, it's always better if we design it ourselves rather than relying on someone else's design. But you know, this PD right has been, you know, great for Empire and HJ in turn, in that it has eliminated the majority of the planning uncertainty in acquiring a building and being able to convert it. And effectively, you know, the planning process is expedited, and we eliminate most of the planning risk that would be associated with buying a site. As you say, some of the government have been tweaking that and made some changes recently, which come into effect later on in the year, August time, which means that it's effectively some of the bigger buildings now won't benefit from PD rights, but you know, there are angles and ways to kind of capitalize on that as well.
Yeah. So that's PD. I mean, in August, so basically just for investors, anything that's over a certain size after August, we're going to have to put in for planning. What that will do is it will just change the way that we purchase. That we will only purchase once planning has been approved. So still, no, will we put any investors' capital at risk with buying something that doesn't come with planning or PD? Just means that I suppose our appraisal team and our teams finding the stock that we look at need to make sure that, you know, they're on the front foot with that when moving forward. Would you agree with that, Paul?
That's it. Yeah, there's more work going in at the beginning, basically. It means that we will have to kind of plan more in advance and put and put pipeline, project our pipeline further into the future to accommodate the time it's going to take to get planning on some of these sites. I think it's 1,500 square meters. The tipping point, which I think is around 30, 35 apartments, something like that. So it just means that we, Empire, have just got to, kind of prepare sooner, really, and probably bulk up that planning team that we've got already in order to take it through that process. But as you say, we will do that under option, or by agreement with the owner at the time, that it may be a condition that they have to get the planning, and we will buy it. We will agree to buy it for a set figure once that's in place. So it's just two different ways of approaching it, really. But I see, every kind of what could be viewed as a negative always has a plus side, and this restriction on the PD rights will probably create more opportunity in that it won't be as easy for competitors to potentially take, to get hold of these sites, because it's effectively a barrier to entry. So, we're a reasonably established organisation in this market, so we should be able to capitalise on that. And it also makes it more difficult for office landlords to dispose of the sites, because there isn't an automatic PD right. So they will need to work with developers or get the planning themselves in order to take them to market, because in most cases the office market is severely declined. So I feel quite confident we can
turn it into
that. Absolutely, yeah.
Great. So just go through, moving forward through the timeline of HJ Collection, because what a lot of investors say, well, I lend my money to a developer, what are the assets in there? Just to let you know, the fund that we're talking about right now is coming to an end. But you can see over a 2-year period what we've actually done and what's in here as security. And you can see we've just done you a quick timeline here. So you can see August 19, we purchased Yorkshire House. September, we started working on that. November, we purchased Attey's house, which, we just showed you work started. You can see as you move your way through, we purchased 3 assets from August to December in 2019, and the work started on them moving forward. You can see July 2020, Yorkshire House was 50% through. We reviewed Horton 5, so that development was under review to look to go into the loan note. Attey's house, 50% completed. September, we'd raised 7 million, and then we purchased another asset, which is St Michael's House in Braintree. Some first lot of interest payments went back in November 20. The way that was done is that there's a couple of sites. So Yorkshire House has got some some commercial space underneath. So that gives us an income soon as we purchase that. And you can just see the timeline moving forward. Feb 2021, just jumping forward a little bit. 2 projects, so that's Attey's House and Yorkshire House, both refinanced. So the way that it works is we use investors' funds to purchase and convert. Then we will go to mainstream lenders and refinance. They will come in and refinance the asset. What that does is that will put normally 70 to around 70% loan to value back into the loan note, which will then allow us to go and purchase more assets. Now we do that cycle twice as a minimum, really, in the 2-year period. We like to do more than that, but obviously with the circumstances we've been in, we've managed to just get 2 cycles in. So everything's still moving in the right way. Then you can see after the refinance, new acquisitions being looked at. Crown Buildings is moving forward. We've put Halton and Hull as acquisitions as a JV deal, both in there for security as well. And the Leeds site is under review, which we're looking at still now. We'll make our mind up whether we will look to put that in. Yorkshire House, next couple of months will start to be tenanted. August 2021 is when some investors that got in the start will be looking to get their interest and their capital paid back to themselves. We're not far off raising the 12 million now. There's about 1 million left to raise. So if this is something that you are interested in more detail, would be happy to speak to yourself. You can subscribe, put your details in. One of our team can give you a call back. But just to go over again, just before we finish, what the investment outline is. So if you was to invest for a 2-year period, which the loan note is, the growth option, so what that means is that you invest in 2 years' time, you get your capital back. You get 24% paid in at the back end, so you get your capital plus 24% paid back. On the income option, it goes down to 10% paid every 12 months. But the first, so you get 5% in 12. You get your 10% in month 12, and then 5% and 5%. So it gives you an income over the 2-year period. But for that, you only get 10% per annum. So there's 2 options there. The security is the same on either of them. You've got a debenture over the company, and some assets will have a first charge, some assets will have a second charge, just depending on where we are throughout the loan note. But ultimately, you have the debenture over the whole company and anything that's underneath that. That security is held by a trustee. That trustee is Blue Water Capital. As I said, thanks for your time. We're happy to speak to you, answer any questions that you've got. And that's really it. Paul, is there anything any more stuff that you'd like to add in about what we do and how it works and the way things are going?
Only that everything's going according to plan, really. We're doing what we do. we feel we're accomplished in conversions, which we're sticking to. And the buildings are getting bigger and in some cases more complex, and we're confident in what we're doing, really. The market's still strong, rental market's still strong. The housing market seems to be improving on the back of COVID. Since over the last couple of months, I've seen it strengthening. We've seen some quite strong offers coming in, so I feel it's well underpinned. So yeah, it's going well.
So things are moving relatively. Things are moving really well. We've got a good pipeline of sites as well. This loan note will be full probably in the next 6 weeks. So if it is something you're interested in, get in contact with the details that we've got there, or put your details in. and we can arrange a call. There will be a second note coming out. That second loan note, because of success, will be the returns will be slightly less. So if yield is what you're looking for, it's the best opportunity to get in, especially at the towards the end of a loan note, because there's ultimate security and there's more assets in there than when you start a new note. But they're all the same. The same security will be added to the second note. So if you've got any questions, feel free to get in touch with us on the details. Me and Paul are happy to speak to anybody. If there's any investors that have any questions for us directly, we're happy to answer them. It's been a pleasure running you through the presentation. Look forward to meeting and speaking at the event live next time. It's been a pleasure, Paul. Thanks for coming on. Hopefully, guys, you found it beneficial and you've taken some positives away. And hopefully we'll speak soon.
Bye-bye.
Cheers.